Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Sebastian Lyon, co-manager of the Troy Trojan Fund, which features on our Welsh shortlist of funds selected for their performance potential. The fund is also one of our 5 funds to watch for 2025. So Sebastian, the Troy Trojan Fund is invested into 4 key pillars. So there's equities, bonds, gold and cash. What do those investments offer the portfolio, and how do you decide how much to invest in each area?
Well, thanks. Effectively, the Trojan Fund is a wealth preservation vehicle. So we try and balance those 4 key pillars as you describe them. Equities are key, and Troy is an equities house. And equities have driven probably between 60 and 70% of the returns of the fund. So equities are the things, stocks are the things that give us that long-term growth. And then what we want to do is structure the portfolio to balance the rest and to also offset those occasional periods where equities do badly. So for example, in April, equities sold off very aggressively, 10, 15%. So we need something else within the portfolio. Well, we want defensive equities as well, but we want other things. And so those are, as you say, bonds, predominantly index linked, because we want protection from inflation, and they've done a good job for us over the last few years, particularly when inflation has been rising and been higher compared to conventional bonds, which have generally been weaker in that rising interest rate and rising inflation environment. We want to have some gold, which does something very different within the portfolio, tends to do well when equities do badly, but it's also a very, very long-term store of value. So it tends to, if you like, do its own thing. But that can be very helpful in periods where markets are risk off. And then finally, cash. Cash is not a burning a hole in our pocket. Cash is to be deployed, it's dry powder, when opportunities arise. So we don't feel, as many managers do, that cash has to be a very small number. Cash can be between 5 and 20%. And we hold that in very, very short-dated bonds. That's where we do hold some bonds, but very short-dated gilts, short-dated treasuries. So we're not taking huge duration risk. We're not taking risk within those bonds. But if markets are weak and we see opportunities selectively or wholesale, we can act very quickly and have the liquidity to do so.
And honing in on gold, it's an investment that's performed pretty well for investors in recent times, but it's notoriously difficult to value. So how do you go about assessing its performance potential?
Well, as I say, it is there within the portfolio to offer us resilience. It's almost like the opposite of debt, if you like, really. And so we feel that we want to have a certain amount of gold because it does what nothing else does. And also, it's sort of portfolio insurance. So rather than having derivatives, it's something that can go up when everything else goes down. That's not been the case so much just in the very recent past. So the last 18 months, gold has done very well in a period where actually other asset prices, particularly equities, have been okay. And that's quite unusual. And I think the reason for that is the type of buyers who've been buying gold compared to historically. So the kind of buyers that have been buying gold recently have been predominantly the central banks. So central banks, places like Poland, Singapore, those places have been diversifying their portfolios into gold and away from US dollars. In terms of getting the valuation of gold, look, it is very much an art and not a science. The key thing is that we do own it, and that it does play that role within the portfolio. We've owned it now for 20 years in the Trojan Fund. We bought it back in 2005. It was $424. Today it's, I think, $3,300. So it's compounded within the portfolio at around 9% in dollar terms, 11% in sterling terms over that time. So we've done very well from it. But the key thing is it doesn't always do that at times when you would expect it to do it. The other thing is we do tend to get less excited about it when it does well and more excited about it when it does less well. So we do bear in mind sentiment towards the asset class. We don't think it's in some massive bubble at the moment, partly because of the point as to who's buying it. It's not retail investors piling in the way they might be piling into other assets, whether piling into profitless tech, for example, or meme stocks, which we saw back in 2021, it's not hot in that respect. But we don't want to get carried away. So we have been reducing our holding, keeping it at a certain level, so taking profits as the price has risen.
And a real cornerstone of your investment philosophy is your desire to protect investors' capital from the worst of market falls. So if you could just tell us why that's so important to you, and looking at the longer term, what could an investor expect from the fund?
Well, I think the fund was started back in 2001, and Lord Weinstock, who started Troy with me as a business, wanted to protect and grow capital that he had made. And I think there are many, many people out there. There are lots of people out there who want to make money, but there are also a lot of people out there who want to preserve what they've made. You know, they may be about to retire, they may not have the ability to make the capital again. And so there are a pool of investors out there who want to protect first and then grow, and grow in real terms. And that is what we are trying to do. And I think we've got a track record of doing that. We started the fund in a period of market turbulence after the dot-com boom, the dot-com bust. But also we protected capital very well through the financial crisis. And we did it again during COVID. And then obviously more recently we had Liberation Day and the falls in the stock market, to a lesser extent, but still double-digit falls, we managed to protect capital. So we have these periods where we're really tested, and we try and structure the portfolio using those four pillars to enable us that when those events occur, and we never know when they're going to occur, by the way, that the portfolio holds up and people think, yes, the Trojan Fund's doing its job for me. You know, I haven't lost the same amount as the equity market. And we recover more quickly if there are losses in months, not in years. And so people feel confident that they can hold it and that it will ultimately protect their capital. So that's what we're trying to do.
And we've seen lots of volatility already in 2025. Interested in what you've made of the year so far and perhaps how that compares to other periods in your career?
These things always rhyme, but they're never the same. At the moment, we feel and have felt that equity markets have done very well. Valuations, particularly in the US, are pretty high. That means that we should be more conservative. We rein back our equity exposure. So ahead of the Liberation Day announcements and the tariff announcements, we were prepared for some market falls. They happened very quickly and very suddenly. We actually lent in and took more risk on that third or fourth day of the market fall. So we increased our equity allocation quite materially by almost 10%. So we can use those opportunities to take more risk when we're paid to take more risk, where prospective returns, when markets fall, everybody panics and gets concerned. That's actually good news for us because it means that we can buy into higher prospective returns in the future with those lower prices. So we're not put off by those lower prices, quite the contrary. We view those as opportunities to make future returns. In terms of what's been going on in 2025, clearly it's been very noisy with a new president in the White House who effectively likes to take a lot of the media bandwidth. That has had an impact on markets. We recall the 2017 to 2020 period. There was a lot of noise. I think the best thing that one can do, keep an eye on the prices, talk to the companies, but try and shut out the noise as best as you possibly can. What we're trying to do is look after the interests of our investors. And so that is what we're focused on, rather than trying to get overly distracted by everything that's happened. But clearly, there is a change within policies within the US, both from the point of view of trade, but also from the point of view of isolationism and defense. And one of the things that we have recognized going back to about 2020 is that we're in a sort of new regime where inflation is stickier, yields are higher, and basically greater volatility. And so we recognize that we're in that new world, and we structure the portfolio according to that new world, which is different from the one which was very low inflation, sort of pro-globalization. That environment that we had up until 2020, up until COVID, is very different to the one that we're in today.
And you mentioned earlier the fund's been running since 2001. you've managed it for that entire period.
Yeah.
Interested in what lesson perhaps you've picked up along the way that might have been useful to know back when you started?
Well, I think one of the lessons is I'm very lucky to be in the position that I am, to have been given the fund to run for that period of time. Patience is absolutely key, to not be swayed by the noise, to try and focus on the good businesses that are going to generate long-term returns. That's the first thing. And I think that actually things are never as bad or as good as they seem. So not to get carried away when things seem very good, where there's blue sky everywhere and everybody's terribly excited. And similarly, when things are difficult, like in the second week in April, don't think that they're probably as bad as they might seem, and probably lean in and be more opportunistic and actually be more positive during those difficult periods.
I'm interested in who you'd say has had the biggest influence on your investment approach.
Well, I think frankly there are two people. The first was Ian Rushbrook, and Ian Rushbrook was the investment director of Personal Assets Trust, which is the investment trust that I run and have run since 2008. But I read about him back in the late 1990s. I like the way he talked about capital preservation, didn't invest along index lines at all, was quite an iconoclast. And I found he very much inspired me, particularly to be prepared to do something different, to invest in a different way, and invest in the way that I felt the most comfortable with. And then the other was actually a French investor, but he was based in New York, who's Jean-Marie Everard, who is a well-known qualitative value investor. And that's really what we try and do at Troy. We're not out-and-out growth investors. We do try and emphasize quality first, but then valuation kicks in. And I think that, and he also held gold on his portfolio, the First Eagle Global Value Fund. So he had a great track record, and he also had a great knowledge of and thought sort of priority of the client base. So he always said, I'd rather lose 50% of my clients than 50% of my clients' money. And that is very much a thought which I would go along with.
And outside of work, how do you switch off?
I play tennis. So I'm a keen tennis player, so every weekend I will be found on the tennis court, and yeah, that's the way I stop thinking about work. Concentrate, keep my eye on the ball.
That's great. Sebastian, thank you very much for joining us.
Pleasure, good to see you.